you think about it, that it would make sense. A new Fed chair comes in, dealing with the previous bubble. The last person blew up, and then so here you go. Good luck with that. There's a big crash. Then what do the Fed chairs do? Well, according to the Keynesian textbooks, they cut interest rates, flood the market with liquidity, and then, there's a recovery. They blow up another giant asset bubble. They start reading the writing on the wall, and they all of a sudden decide to retire and go write their memoirs and hand that mess off to the next person. So I think what happened is Bernanke came in. There was a huge crash. The housing bubble collapsed, and it wasn't, totally his fault. That Greenspan had a lot to do with that. Then he blew up another giant bubble, realized that, and then they handed it over to Yellen, and now it's her job to oversee this big crash in the best way she can. So I don't think the Fed is going to expand until something really awful happens. And just look at a little bit of the clues here. The so-called taper, that was when QE3 wound down, right? That they had originally been buying assets at $85 billion a month and then started reducing it. That was supposed to happen in September of 2013 under Bernanke. They didn't do it. They pushed it back to December of 2013. That was when Bernanke officially stepped down. Yellen gets, the Senate confirms her in January of 2014. She's sworn in, and that's when the taper fully goes into motion. Okay, so in terms of a regime change, if you will, it really does look like Yellen comes in to oversee this switch from expansion to let's hold it pat. And in particular, the chart indicates it, but also there's various other measures you can look at. A lot of people, I think even hard money types, Austrian libertarians, they have this idea, Bernanke and Yellen have been inflating like crazy. No, Bernanke inflated like crazy. But if you look at certain metrics, Yellen actually has been overseeing just holding steady. In particular, since the fall of 2014, the Fed has just been rolling over its portfolio. As certain bonds mature, they go out and buy new ones and replace them, but their overall position has been neutral from that point forward. So in that respect, my reading is that Yellen, and they raised interest rates also. So I think the Fed is actually trying to tighten, but trying not to cause a crash. And so I believe we're going to see this bubble eventually pop before any dramatic action by the Fed. Let me also just mention, again, this is sort of anecdotal, but in terms of giving us a framework, historically, the 5 biggest percentage drops in the U.S. stock market all happened in the fourth quarter. And the 3 biggest drops all happened in October. And so again, if we primed you to think, yes, there's a crash coming, we just don't know when, it'll probably happen in the fourth quarter. So if it's going to be this year, it's going to be very soon. Maybe we'll get through this year, maybe we won't. We don't have a crystal ball, but I'm just priming you to think that this is partly why we want to deliver you this message right now, because we think it's really urgent. One more thought on this issue of timing. Let's suppose you hear this message, you're intrigued, you start doing research, and boom, the stock market crashes and it's bad. Don't think, I missed it. Too bad I didn't hear about this 6 months ago. Because in the dot-com crash and the housing bubble crash, yes, there was a big drop, but then the market kept sliding further and further. So in particular, the dot-com crash, the market fell 48% total over 2.5 years. Okay, so when the market finally bottomed out, that was a 2.5 year span. In the '08 crash, the market dropped 50% total, but that happened over a year and a half. Okay, so again, even if you hear this, we intrigue you and you don't take action and then there's a big drop, don't worry. You still have time to do something that, assuming history repeats itself, that the market would continue coming down. Let me also just mention that in terms of sequencing of events, we're warning about the threat to the dollar and so forth, but the immediate threat we think is to the U.S. equity markets. It is possible that there's a bad crash also in Europe, and that perversely could make the dollar strengthen and treasury yields fall, right, as people panic and rush into the apparent security of the U.S. dollar. So that is consistent with our worldview. We're not saying the dollar is going to crash 6 months from now. We just think that's more of a long-term threat. So in terms of the sequence of these storms, the thing that we think is on the immediate horizon is a drop in U.S. stock markets and real estate markets. But the dollar itself, again, that may strengthen first just because the situation's bad in Europe as well. So just so you understand. One last thing I'll show you. There's going to be a new slide flashing up of what's called the Exeter Pyramid. Let me just explain what this is, and then I'll turn it back over to Carlos. This guy, John Exeter, he wasn't Fed chair, but he was high up in the Federal Reserve hierarchy. And in the 70s, he did a lot of research on financial crises, panics, both in the US and around the world, and just wanted to draw some conclusions, some patterns. And this pyramid is showing the rush to liquidity. All right. And that what happens is, you can see from this, that the top where it's in red, that's the stuff you don't want to be in. If a panic ensues, that stuff drops in value very quickly. And the stuff towards the bottom of the pyramid, is where you want to be. That's the stuff that's going to gain relative. All right. So it may be the absolute levels of prices move based on the strength of the currency, but these are showing relative movements in valuation of these types of financial assets. So as you can see, when there's a panic, people rush to things that are liquid. So this idea of liquidity, you could have a house that you say, oh, my house is worth $200,000. You don't mean that tomorrow you could turn your house into $200,000 in the bank. You mean if I marketed it properly, had 6 months, right? So a house is not very liquid, whereas a share of a major corporate stock, that's pretty liquid. You could call your broker, turn that into cash pretty quickly. So that's the way to think about stuff that you can turn into cash very quickly, is the sort of thing that people value when there's a panic and there's uncertainty. They rush to stuff that they know they're not going to have trouble finding a buyer for. And then ultimately, as you see, gold, we could also put silver, the precious metals are at the base of this pyramid, because if a really bad situation happens where even the currency itself is in danger, people rush to the market's money, the historical money, the stuff that people voluntarily use as money, namely gold and silver.